What's the single biggest expense most people pay over their lifetime? I'll give you some hints. It's not your house. It's not your kids. It's not even your groceries. It's taxes. Taxes are often your single biggest lifetime expense. And for high earners or successful investors with large capital gains, that number can reach into the tens of millions. But here's the good news. With the right tax-aware investment strategy, much of that money doesn't have to go to the IRS. It can stay with you to fund the life you want now and get passed on to build the legacy you care most about. Hi, I'm Hilary Hendershott, certified financial planner and founder of Hendershott Wealth Management. In this video series, I'm going to let you in on a few key details of ultra tax efficient wealth management, or UTEWM, our firm's proprietary suite of tax-aware financial services designed to help you minimize capital gains taxes and build flexible, lasting wealth, including a new-to-market tax-aware investing strategy that can save investors 7 or even 8 figures over their lifetime. And more importantly, why the impact of those savings is so much more than your portfolio value. If, after watching, you believe you might be a suitable client for this kind of strategy, please fill out the contact form on our website at hendershottwealth.com/contact. We're looking forward to working with you to keep your hard-earned money in your pocket, not Uncle Sam's, so you can make the most of your wealth. Before we go any further into what tax efficiency is all about, I do want to mention that my team doesn't actually prepare tax returns, and the clients with whom we use the strategies inside UTEWM do need to have a professional tax preparer, a CPA or an EA. We collaborate with that professional to make sure the tax-aware planning we do from our side is incorporated into our clients' returns. Now, let's get into some examples of just how intrusive capital gains taxes can be when it comes to building lasting wealth, and why the rest of this series is so important to pay attention to. First, there's the investor who holds on to concentrated appreciated stock, because this time will be different, right? Think about what happened in the tech sector in 1999 and 2000. That, quote, "this time will be different," unquote, mentality led to investors cramming their portfolios with concentrated stock from famous companies: Cisco, Webvan, Pets.com, Excite at Home, InfoSpace, Lucent Technologies. I'm sure you remember. The same thing happened in the financial crisis of 2008 and 2009, with investors holding large swaths of high-performing stocks like Lehman Brothers, Bear Stearns, General Motors, IndyMac Bank, Fannie Mae and Freddie Mac, Ford Motor Company, and Merrill Lynch. And what happened to all those high-performing famous stocks? They went to zero or near zero, and investors whose portfolios were highly concentrated in those positions, some of them lost everything. I mean, I've truly seen people go from multimillionaire to delivering the mail. Not my clients, of course. But I'm not necessarily here to talk about concentration risk. I'm here to talk about why investors hold on to concentrated or appreciated stock. And sometimes it's because they're bullish on the market, but mostly it's due to inertia because they don't want to pay the tax. And it makes sense. In 2024, if you sold Apple stock with a $3 million fair market value and an extremely low basis, even let's just say for round numbers, a $0 basis, to diversify your portfolio could have triggered a tax bill of around $865,000. That's money right out of your pocket. And that's what I think of as wealth destruction. That number is, of course, dependent on a number of factors, including your state of residence and total taxable income that year, but it gives you a sense of just how punitive capital gains taxes can be. Next, let's consider a real estate portfolio. I knew a couple who built a real estate portfolio worth $25 million in equity. That's net of mortgages. They bought those properties in Santa Clara County, California, before Santa Clara County became Silicon Valley. So, assuming a $5 million basis and a 30% tax rate, if they had sold all $25 million worth of their real estate, their tax would have been approximately $8.3 million. If they had chose to sell just $10 million of their real estate, their tax would have been around $3.3 million. Again, that's wealth destruction, and the hesitation is real. So they held on to that entire portfolio in order to avoid that capital gains tax bill. And as that portfolio appreciated, those properties needed more and more maintenance and money. Instead of selling and triggering capital gains taxes, they ended up becoming full-time property managers. And because of low cash returns or cash income from the portfolio, they were living on just $65,000 a year in net income. That is heartbreaking. Okay, last one. Consider Tom, a fictitious owner of a manufacturing business who's thinking of retiring. He receives a valuation for his business and he's shocked and happy to find out that it's $10 million. But then his CPA delivers the bad news. His tax bill resulting from the sale of his business would be well over $3 million. So Tom holds on to it, working longer than he wanted or needed to, with no real plan or path forward. The point here is that capital gains taxes can be a real impediment to building wealth that serves you today and for all of your tomorrows. But it doesn't have to be that way anymore. The simplest and most direct way to avoid taxes is to not make any money. But of course, that leaves you without any money. I want you to live a rich life, which means having access to abundant resources, including money. To my team and I, the right way to avoid taxes is to make lots of money and have an effective strategy to keep more of it. If you can legally have a high income while paying less in taxes, we call that tax efficiency. And what you'd be experiencing is what we call tax alpha, extra returns through smarter tax strategy, not extra risk. It really is as simple as this. Let's say two investors have the same portfolio performance before taxes. Investor A uses strategies within our UTEWM suite, like tax loss harvesting and asset location strategies, and investor B doesn't. What's the outcome? Well, again, we have the same investment performance, but investor A pays less tax. So investor A ends up with more money. That difference is tax alpha. Alpha meaning outperformance, and tax meaning it came from smart tax planning. And the reason I'm recording this today is because there are new solutions available to you that are far superior to anything you've used or known about in the past when it comes to achieving tax efficiency and tax alpha. In fact, while tax efficiency and tax alpha are the right industry terms, if I'm being honest, I really call the outcomes you stand to experience here tax miracles. Let's start with something you're probably well aware of. One of the most powerful and accessible ways to increase your tax efficiency is by taking advantage of tax deferral. That's why savvy investors contribute to IRAs and other tax-deferred retirement accounts. You get to keep and invest your full earnings, enjoying that magical compound growth on your full balance until you start withdrawing it in retirement. Not paying taxes until the IRS requires it, years or even decades later, is a proven way to build wealth. But here's the catch. Contributions to tax-deferred accounts are limited. That means high net worth investors almost always end up with a significant portion of their assets in fully taxable accounts. Not only that, but if you sell a business, real estate, or have any meaningful equity compensation, you're likely facing a huge tax bill, as we saw with our 3 examples up front. I've witnessed people who are eager to avoid taxes make some seriously questionable financial moves in the name of tax efficiency, from risky alternative investments and exchange or swap funds to the alphabet soup of crazy trusts like CRATs, CRUTs, GRATs, and IDGTs. The list goes on. To their credit, they're just taking advantage of the frankly underwhelming set of tools that have been available to them. But what it's really doing is introducing unnecessary complexity, potentially risking an audit, and by no means leading to a more positive impact on their financial future. The trade-offs here are real. Typically, these investments offer lower returns, higher risks, and less liquidity. But that's not how meaningful wealth is built. And it doesn't align with what we want to create here at Hendershott Wealth Management, which is a world where people are thriving. We want you to build significant wealth and enjoy it. Locking your money into risky or restrictive investments that compromise your financial goals doesn't allow for that. And now we're getting to the good stuff. Throughout this video series, I'm going to be telling you about ultra tax efficient wealth management, our firm's proprietary suite of offerings that helps you not just manage your wealth, but maximize it through smart tax strategy. UTEWM is a personalized investment strategy utilizing a suite of financial tools that help you continue to earn strong investment returns while keeping your tax bill very, very low. At first glance, that may sound too good to be true, but I assure you, my team and I are fiduciaries. The tools I'm talking about are effective at significantly lowering capital gains taxes, and it's all fully IRS compliant, meaning there are specific sections of the tax code that explicitly allow for tax alpha. And it's been part of what family offices have been doing for nearly a decade. It's just only recently that really good investment managers have decided to make it available more widely. Before I get into the specifics of UTEWM and how the strategies within it decrease what you pay in taxes while keeping your investment portfolio entirely on track, let me tell you how proactive tax planning became a core part of what we do. When I first started out as a financial advisor, I was taught to treat taxes as static. The message was basically the tax is what the tax is. The good tax shelters of the 80s are gone, and the only way to reduce your tax bill was by using specialized investment vehicles or legal structures like the ones I mentioned earlier, most of which involved higher risk, lower returns, or long lockup periods. So for a while, I just accepted that. I assumed the tax preparer's number was gospel, and we'd plan around it. But then I started noticing mistakes. For example, we'd harvest $100,000 in losses for a client, but the next year, the tax preparer would forget to carry those forward on the return. That's potentially a $33,000 error. I couldn't believe it. That's money coming out of your pocket, and unfortunately, it's not uncommon. So my team and I started reviewing client tax returns every year. And honestly, I was shocked at how often we found costly mistakes. And that was the moment I knew if we're truly acting in our clients' best interests, we need to go deeper on tax planning. So our team invested in formal tax education and added tax planning software to our wealth management toolkit. As we dug deeper, we saw so many more ways to improve tax outcomes, not just on retirement accounts or one-time events, but year after year for life. And that's how our ultra tax efficient wealth management approach was born. It's a proprietary process that minimizes tax drag across your entire portfolio while maintaining investment quality, liquidity, and access to your wealth. In short, you experience financial benefits that, in this case, don't come from investment returns. They come from tax efficiency. Again, that's tax alpha. This suite of services includes ongoing portfolio strategies like direct indexing, tax-managed mutual funds, and continuous tax loss harvesting. We also use advanced planning services like equity comp and IPO planning, maximizing tax-deferred contributions, and most recently, tax-aware long-short investment strategies offered inside separately managed accounts powered by AQR Capital Management through its Flex SMA product, which is something you'll hear more about in following videos. And that last one is a mouthful, but it's worth paying extra attention to because it has the potential to save suitable investors 7 and even 8 figures in capital gains taxes over their investing lifetime. If your eyes glazed over a bit while I rattled off that list, don't worry. You don't need to be fluent in financial jargon because we are. Our job is to make sure you understand why tax efficiency matters and how we can help you experience tax alpha. And that's why you're watching these videos. Instead of getting bogged down in the nitty-gritty, this series is designed to help keep things high level and digestible so you leave feeling informed and empowered not overwhelmed. Here are your big takeaways for today. Tax efficiency is one of the most powerful and overlooked levers for building and keeping wealth. You can experience tax alpha, that's higher net returns through smarter tax strategy without taking unnecessary risks or sacrificing returns. Everything we do is fully compliant with IRS regulations and rooted in fiduciary care. Ultra tax efficient wealth management is our suite of white glove tax aware investing solutions designed to help you keep more of your wealth so you can use it to live a life that allows you to thrive. To the right investor, some of the strategies inside UTEWM can make a 7, even 8-figure difference over time. That's millions or tens of millions of dollars of additional wealth. And that's what we want for you. Now that you've gotten to the end of this video, you might have a better idea of whether or not UTEWM could benefit you. If your curiosity has been piqued, I invite you to head to hendershottwealth.com/contact and fill out the form to book a discover call. You'll be paired with a lead advisor on our team for a complimentary conversation where we get to know you, your goals, and your financial picture. And we discuss how the strategies inside UTEWM might benefit your financial future. And if you're not ready to take that step yet, head to the next video in this series where I'll explain why tax efficiency isn't just about money, it's about peace of mind and quality of life and freedom. Because if you're serious about building meaningful wealth and putting it to good use, this is a conversation worth having.